20%. It's the magic mortgage number. It's the down payment you need in order to avoid mortgage insurance. But there are a lot of other benefits associated with putting a 20% down payment when making a home purchase. And here they are. And that's really the primary reason the less money you put down, the higher, is because it's a requirement.
My name is Scott Wynn, and I am a licensed mortgage advisor with the Wynn and Egan team at Citywide Home Loans. If you want to buy a home in the next 12 months, then click that subscribe button, and together we'll make it happen.
I'm covering the benefits of 20% down payment when making a home purchase, but I want to be clear that it's certainly not a requirement. There are many loan programs that allow for far less than 20% down. In fact, as low as 5, 3, or even 0% down, depending upon your particular situation. So if you're interested in a lower down payment option, check out some other videos that I've recorded for more details on how those programs work. But today, I'm covering what are the benefits of a full 20% down payment. And the first one is no mortgage insurance. And that's really the primary reason why 20% is so popular. With conventional financing and a 20% down payment, you can avoid mortgage insurance. Now, what is mortgage insurance? Basically, it's an insurance policy to protect the lender in the case that you default on your mortgage. And at that 20% down payment mark, the lender no longer requires mortgage insurance, so you can avoid the cost of mortgage insurance within your mortgage. But there are a few other benefits of putting 20% down. The second benefit of putting 20% down is that you might be able to get a lower interest rate. See, mortgages and the rates on mortgages are tied to the risk. The higher the risk of default, the higher the interest rate generally is. One thing that impacts risk is down payment. The less money you put down, the higher risk there is to the lender that a default may occur. And so generally you'll find that interest rates are higher as you put less money down. Now, it's not always the case, but it's a general statement in terms of how mortgages work. So as you can imagine, as you put a full 20% down versus, let's say, just a 5% down payment, the interest rate will likely be lower. Now, there are some anomalies here, and it's all, again, based off of risk. And I've talked about this before, which is why sometimes a 20% down payment might actually carry a higher interest rate than, let's say, a 15% down payment.
There's a lot of little nuances that you may not be aware of when it comes to mortgage financing and how it impacts interest rates and mortgage insurance.
You can check out that video here, but in general terms, the more money you put down, 20% or more, the lower your interest rate may be, saving you money over time. The third benefit of putting 20% down is lower interest. Lower interest over time. Not just talking about the interest rate in and of itself, but the amount of interest you'll end up paying over the life of the loan. See, obviously, the more money you put down, the less your loan amount will be. Well, the lower your loan amount, the less interest you'll pay over time. You'll save thousands, if not tens of thousands of dollars over the life of the loan by putting more money down. The fourth benefit of putting a 20% down payment when making your home purchase is to stand out. Today's market is hot. There are more buyers than there are homes for sale, which just creates a supply and demand issue, which is increasing prices and also giving control to sellers in selecting the offer that's right for them. In many cases these days, buyers are competing against other buyers to get their contract accepted by the seller. Well, one way to stand out is by putting more money down. Just put yourself in the shoes of the seller. If you're looking to sell your home and you have a buyer that's looking to put, let's say, 3% down versus a buyer that wants to put 20% down, which one seems better to you? Well, most sellers and their agents would agree that putting a larger down payment would reduce the risk to them and would be more attractive in terms of the buyer that they'd like to select, and therefore you have a higher likelihood of getting your offer accepted with a larger down payment. The last reason a 20% down payment may be beneficial is because it's a requirement. Some loans, depending upon your situation, may require a 20% down payment. An example of that would be when purchasing an investment property. Investment properties carry a higher risk and therefore will require a larger down payment to help offset some of that risk. Most lenders these days require a 20% down payment when purchasing an investment property, so all of this leads to the question, is putting 20% down right for you? I have a quick favor to ask. If you're finding this video helpful, if you could do me a favor and give me a quick thumbs up, it would really help me to reach more people like you interested in learning more about down payment and buying a home and financing that home purchase. Well, I really believe there's two major buckets of home buyers: first-time home buyers and repeat home buyers. So let's talk about first-time home buyers first. First-time home buyers generally are going to have less saved because they haven't had a vehicle to help them in saving, such as a previous home that's appreciating in value. So with first-time homebuyers, if you haven't saved up a full 20% down, I wouldn't necessarily suggest that you delay your home purchase until you do, unless you're very close, let's say between 15 and 20%. But again, there's that anomaly where putting 15% down may actually be a better option than saving to the full 20%. So if you're a first-time homebuyer with less than 20% down, my suggestion would be to investigate the options, look at what the payments might look like with mortgage insurance included, or alternatives such as lender-paid mortgage insurance and so on, and look and see how that might play into the short-term and long-term financial goals you have. Delaying your home purchase as a first-time homebuyer may have more financial implications than if you were to purchase now with mortgage insurance, because you'll be missing out on all the appreciation that the home may gain over the years that you would be saving for your 20% down payment. Not to mention that interest rates are currently at historical all-time lows. Now the other bucket, current homeowners, those that are looking to sell their current home and purchase their next home. Well, many times people, when they sell their home, will take the equity in their home that they're gaining from the sale of that home and roll it into the next home purchase, allowing them to put 20% or even more down. And in many cases, I would say that's the best strategy. However, there are situations where rolling that money into the next home purchase may not be the best strategy. And here's why. In some situations, homeowners may have higher interest rate debt, or other places where their money can work better for them and serve them in both their short-term and long-term financial strategies. Things like retirement planning, college savings, or just their debt reduction strategy. Just imagine that with that extra, let's say $10,000 that they would have to get to a full 20% down payment, they could pay off a vehicle that had, let's say, a $500 per month payment. Well, that would free up a lot of monthly cash flow to help in offsetting their monthly obligations, and therefore could then roll that extra $500 savings into paying off their mortgage faster and eliminating any mortgage insurance cost that they may incur because they're putting less than 20% down. So again, it goes into the overall planning of how to structure their mortgage into their financial strategy to determine whether or not putting that money down is indeed the best strategy.